Yo, what's good, guys? Alright, so here is the video that I have been requested to make in regards to liquidity pools. Now, a lot of people have been asking, how do you determine liquidity when you're looking at the chart by simply looking at the candlesticks? And it seems that people just need a little bit of an explanation behind understanding how to take advantage of these liquidity pools that we keep referring our projections to. All right. So first things, what's a liquidity pool? I call it a liquidity pool because I just think it is easy to help you understand what we expect from a liquidity pool. All right. Now, liquidity is where the market maker had previously opened longs or opened shorts at a particular point in the chart. And we anticipate that at some point in the future, they will want to go and revisit those points. All right. Now, this strategy, I'd say about 90% of it is all down to the candlesticks. Why? Because all the indicators out there, they do not give you a signal until a candlestick has formed. So why not focus on the development of a candlestick? Because you're going to be geared with more information about the development as opposed to waiting for the close of the candlestick. Yes, the close of the candlestick is going to tell you where price was favored. In other words, does it favor a higher close or a lower close? All right. Focusing on the development of the candlestick is going to give you the better edge as opposed to waiting for an indicator to tell you whether to buy or sell on the close of price. Now, the close of price is valid on the daily time frame. All right. That's great. The daily tells you where they ended up at the end of the session. That's what's really important, which is why we make a lot of reference to the daily open. All right. The daily open will be this purple line here. That's where it started, and by the next open, that's where it finishes. Okay, so you can see they pulled away. All right, so it closed lower. But what and how can we really utilize these liquidity pools? All right, so excuse me, let me get myself comfortable. So here we go. Firstly, there are four types of candlesticks that we can pay attention to. Got the red candle, green candle, and of course, wherever they are, you've got the violet candle, and we have the blue candle. I'm not really finding any blue candles on the chart. All right, that's because I'm on the 1 hour time frame. So if we drop down to the 50-minute time frame, there you go. We've got a blue candle right there. Okay. Now, green candles mean that volume is highly above average, so it's at its maximum point as such, and the blue candle implies that volume is starting to rise. All right, likewise with the red candle, it means that volume is at its highest, and the violet candle implies that volume is starting to rise. However, it's not the volume that you think. It's tick volume. It's how many times price changes to develop the candle. So look at this candle here. You can see it's finished red. All right. But what's happened in this candle is price has changed a certain amount of times within this candle, which has led it to finish lower than its open. That gives us information, because we know the market maker will only buy when price is dropping. And we know that he only buys when price is rising. However, within the same candles, when price is rising up, we know they're building shorts and closing their longs. Yeah? Because look, this red vector was the market maker opening shorts, opening longs and closing shorts. Opening longs, closing shorts. Opening shorts, closing longs. Opening shorts and closing longs. Look left. Recovery of the vector right there. Recovery of the vector right there. Look at the red candle, green candle formation right there. All right. A basic understanding of candlesticks is important as well. All right. However, conventional wisdom in light of candlesticks themselves, all right, retail traders are misled to believe a certain thing. All right. So here's an example. People see that these pins to the high imply that the market is rejecting those zones because it means that they don't favor higher prices. They always favor every price. Why? Because that's where there's liquidity. See, the poor soul that went long here had an order set to go long on Bitcoin. Now he's experiencing a very series of unfortunate events if he's still holding, because he's going to hold his position on the principle that he can buy the dip. Well, unfortunately, that dip ended up going further and further and further down. If he understood the concept of the cycles themselves, he would understand that the price coming away from the peak formation and hitting the highs, and price had deviated away from the moving average. At some point, we are going to be seeing a retrace back to the 50. Okay. If he was understanding of that philosophy, he would know to get out of his trade and not grant himself buying the dip. You see, when you're coming out of a big pattern like this, you are naturally going to be seeing a bigger retrace. Look at this W formation right here. It's a small W pattern. Price has come up out of the zone, taken out the midpoint. It's come up out of the zone. It's retraced. Now, depending on what Bitcoin does at this point in the chart, it's going to determine how long the next level rise is going to occur. Is it going to hold in this zone, drift sideways and wait for the 50 to cross over the 200, come down to test that and then make its way? Or is it going to simply drop from this point, come down and then make the test and continue higher? So, how do we really determine liquidity pools? Well, we need to pay attention to the candlesticks, all right, from the previous sessions. Now, we don't need to go so far back into the session, all right, because granted, when you do, you're probably going to see the recovery. What you want to do is you want to see from the hard left of the chart, all right, and then look at the far right and say to yourself, where could price travel to where there is interest? So that's how we come up with this projection point right here. We've got this little pool of liquidity right here. Okay, now we do know that these candlesticks, when they recover, all right, you always see me saying to you to look at the one start of the candlestick and then look right, and it's always recovered, which is why I will include this small zone right here. Okay, because this zone has been recovered up to there. Now this candle has pinned up and recovered this point. All right. However, price will still travel through that because there may be some more liquidity in this zone before it reaches the bigger pool of liquidity up here. All right. Now, look at this. We did this on the stream on Friday night. We said that this is the next pool of liquidity that Bitcoin needs to get to. Now, we were all the way down here, okay? We were waiting for, that was it, here was Friday. And we were waiting for Friday to effectively show its hand. And we said that this is the next pool of liquidity. Price was in and around and building its positions below the 40K mark. And look, the 40K zone got broken on massive volume, tick volume that is. Now, I will be doing another video on understanding whole numbers and half numbers and how market makers build their positions above and below these zones. All right. So don't worry, I've got that video coming to you. But realistically, the pools, the liquidity pools themselves, okay, you don't need to look too far back. Granted, Bitcoin has got a lot of liquidity that it needs to come back to very soon. Look at that. You got vectors over here. You got that vector, this vector. Man, you've got these vectors up here. Look at that one there. And you've got this one going all the way over here. All right. You've got this one up here. Yeah, it takes us to the 45 zone. Then you've got this liquidity pool up here. Then you've got the big daddy up here. And then you've got nothing else after that. You might have that liquidity pool right there. But if Bitcoin is coming back towards the 56 mark, then boy, you know it's going to be coming up to 60 again. All right. So coming back down, where can we assume that price is going to go based on what we understand about liquidity pools? Well, firstly, we need to factor in a couple of things. Is price above the 50 EMA? Yes. Is price above the 200 EMA? Yes. Is price above the 5 and the 13? It's working that zone right now. Where are we in the chart? Well, it's Saturday going into Sunday now. All right. So we are expecting a little bit of, volatile movement in and around this zone. And then Sunday night, Monday comes in. We've got the psychological high and low for the week that need to be formed. And then we're expecting a Monday false move week beginning. And then Tuesday we'll start to see the true intention by the market maker. When you're looking for liquidity pools, you need to be understanding what is happening in and around the consolidation before it's looking to hit these pools. Because if you're looking at this zone right here, you can see the confluences. We've got a pattern here. We've got the psychological high being supportive. We've got the stopping volume, vector candle coming in at the lows, but not sending price lower. All right. Jump onto the 15-minute time frame. You've got yourself influx of vector candles coming in, but not allowing price to go any further than a specific point in the chart. They're keeping it very close to the 34K mark because they like to build their longs below key notable areas. They start crossing over on the moving averages. It's like collating all of the confluences, and it's just simply favoring higher prices. Now, if it doesn't go your way, welcome to trading, guys. Right? If it goes your way, welcome to trading. What you need to understand is we will never get, there's no such thing as a perfect entry. Now, Rugs Free Crows says, he said something, it's perfect in your eyes as such. It can be perfect in your eyes, but logically, you will never get a trade that is guaranteed 100% going to pay you out all the time, right? Which is why we add confluences to our trading. The liquidity pools or the candlesticks or the areas that the market maker are likely to come back to. Those are like the guidelines. They are the previous footprints that the market maker has put in the marketplace to help us understand his intention. Okay. Now, a question that is thrown about in the actual streams is, Tino, there's a candle all the way back in December 1956 and whatever. All right. I'm not interested in those vector candles. When price gets somewhat close to it, then I'll start paying attention to that point and base my decisions on that. Here is an example. Let's take a trip down memory lane. You remember this vector candle right here? Well, how many of you were paying attention to it when it was all the way up here? Not many. Did we need to pay attention to it? No. Why? Well, look at how price was behaving. We've got the little V pattern right here. Price comes out of the zone, first retrace, forms a W formation, stopping volume, vector candle right there, shift out of the zone. Now, while price was making this high, we knew that at some point they would come and bring price back down to these points. So we had our trigger fingers ready. We were waiting. Then you see this M formation appear. And then what happens? Price starts to break down. You see, when you're paying attention to what has happened previously and you start coming to the chart in and around this zone, you're going to be looking at it saying, hold on a second, could price continue higher? Well, let's look at the averages. Is price extended away from them? Yes. Are we seeing climatic volume at the highs? Yes. Look at these vectors here and look at these vectors here. All right. Where are we coming from? Are we coming from a level 1, level 2, level 3? Where's the peak? All right. So then as you wait for price to show its hand, I mean, look, you've got resistance at the 800 EMA, which is the 200 EMA on the 4 hourly. You see price breaking down, comes back down into the moving average, comes back down towards the 200. You're looking left, vector candle complete, vector candle complete, vector candle complete, vector candle complete, vector candle complete. Now, how long did it take for that vector candle to get recovered? Well, for every green box is a day. 1, 2, 3, 4, 5, 6, 7, 8, 9, obviously weekend, 9, and 10. It took 10 days to come back to that vector candle. Okay? So if you are looking at the chart in light of what's going on right now, okay, We have this vector candle, which only happened 1, 2, 3, 4 days ago, 5 even. And we've got these vectors up here, which happened quite a while ago. So back in the 16th of June. So we have traction. We know that if price starts moving up in our favor, we know where it's likely to go. Because the way they're going to deliver price, you're going to see a rise, retrace, continuation. It's going to come back to the moving average, test it and break away from it. If you see the momentum, likely it's going to come towards these projection points. Now, the reason why the projections tend to play out in our favor is because the projections are determined when price is very close to a place in the chart where we know that there's liquidity for the market maker to use the money that they've been trapping from the retail trader from one direction and use it to open trades to another or realize a return on previous orders. Remember, the market maker can be as irrational as he wants with his cash. It doesn't matter. All right. He can take the liquidity from this point. Say he didn't recover this vector candle. He could send price all the way up and even further up. Okay. Because if he's at a loss here, he can double up down up here as well. He can make the loss here back up here by doubling up his position and inducing the retail trader to believe that it's going to continue higher. So he gets him to commit more money at a higher point. And then you start seeing these big vectors in and around the highs and everybody's excited about price rising. Market maker has just doubled up his position down here, offset the loss, and he's made even more money up here. All right. Don't get too caught up with trying to establish whether or not a candle will recover another candle. Okay. Just look at the time frame that we're getting in and around these zones. Drop, 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 drop. Notable volume at the lows. They start coming back up, consolidate. They recover the first vector. If you were to see this pattern right here, you would have said to yourself, okay, I can see a projection point up here. If they favor higher prices, I'll be able to put an entry in and around this zone, put my stop below this level here, and wait to see if they do take out that point. Granted, bang, they shifted out the zone. Happy days. Same story is happening right now. Okay, look at this green vector candle. Now, you can see that the wicks themselves, if you look ever so closely, you can see the wicks have started to come and recover this vector slightly. Now, you've got to understand is this. What you have to understand is this. They stopped price in this zone. Why have they not gone lower? Well, we need to understand the following. When did this green candle become a green candle? Because it was rising and then it may have turned green at this point. Because it was all the way up here, green, and then it pulled back. All right. So they may have started opening their shorts at that point. So by sending price high, they managed to get their shorts filled, got some profit from that move. And then they, of course, managed to close a couple of longs in the same process. If you look left, you've got yourself a liquidity pool that they've recovered. All right. Now Bitcoin is where it is right now. And we're waiting to see if she's going to continue up towards the M5 pivot and potentially try and take out this liquidity pool right here and this liquidity pool right here. Now, I hope that video does put things into perspective for you. All right. Don't put too much pressure on yourself to, thinking that there's this mad science behind understanding liquidity pools. There's no such thing. All you're doing is following the market maker's footprint. Okay. Try and understand that there will always be variance. Sometimes it's not going to work out. Sometimes it will. Our goal, in order to overcome the exposure of variance, because variance will always be there. But if we can minimize its presence, all right, and the way we do that is by adding confluence to confluence. Add caution to caution, as the old Chinese proverb says that Steve Nissen wrote in his book on the second part of his book on Japanese candlesticks. He said, add caution to caution. One big page that says it. But do not be too cautious to the point where you don't place a trade, because what you're trying to understand about trading and understand about this strategy, it's not going to be put into practice if you're reluctant to take a trade because you're scared you're going to be wrong. Welcome to the hardest, easiest way to make money, guys. The whole purpose is to try and be wrong, but keep it as cheap as possible, but learn the same lesson as you would if you lost a ton of money. Yeah? Ultimately, if you lose 5 grand or you lose 10 grand, the lesson will still be there. At least with, if you lose 10,000 pounds, it's going to be an emotional lesson. If you lose 100 pounds, you're not going to have no emotion. You're going to say, it's 100 pounds. What can I learn from this? So you'll be more focused in learning. Your feedback mechanism from £100 loss will be more rewarding as opposed to the feedback mechanism from a £10,000 loss. Why? Because there's a lot of traders out there that have come from losses in trading and they're trying their hardest to recuperate that loss. They are married to the loss. They can't believe it. They won't accept it. And that is reflected in their trading, which is why they will continue to lose. They don't become conservative. They become risk averse, man. They do not like to commit any money on the trade, and they do not want to be in too much exposure. You are saturating your progression as a trader. Try and keep your losses to a bare minimum so that you can reflect on the loss systematically and objectively, because dealing with a loss emotionally, you are going to be in a rut for a very long time. Trust me, I've been there. Believe me when I tell you, I've held on to losses for days. I remember I had 6 months off trading. I literally got my laptop, slammed it shut, and I said, forget this game. I could not handle the amount of money that I had lost in that week. I needed to come away. But I paid a very expensive price to understand something. And that something was, if I can learn to lose and take the feedback from a small loss and make it a systematical and objective feedback mechanism to help me understand how to minimize my loss in the future, I know I will be able to protect myself when I'm trading in the future. If I go and lose myself another 10, 20 grand, I'm going to be putting my head in my arms and I'm going to be crying about it, man. I'm going to be upset. I'm going to feel anxious. I'm going to look at a chart and feel sick. I'm going to be seeing so many people around me making money, and there's me with a 20k loss under my belt, and I'm trying to recover from it. The moment you're stepping into recovery, it will never happen in this game. All right? Recovery in this game is a bad move. If you have experienced a large loss, you need a reset. And the only way you can reset is effectively to fall back in love with the game of trading. So stop for a while. Get it out your mind. Come away from the charts. All right? Because you're wounded. Give yourself a chance to heal. If you're not going to heal, all right, you're not going to perform. All right? Now, I hope that brings things, puts things into perspective for you. All right? I'll go into more detail on this on the streams as well in regards to liquidity pools, but I wanted to give you this video just to give you a heads up on how to really approach the liquidity hunt. All right? Because that's all we're interested in. We're looking for pools of liquidity. This is a short-term day trading strategy. My goal is to exploit the pumps in price. All right. I have no interest in Bitcoin going to 70k when I'm looking at price right now at 34.5. I'm not interested in what it does there. All right. I don't care about 70k. I will start thinking about 70k when price is at 65, because I will know that at some point the market is going to rise. It's going to retrace, form a few vector candles, pull back a little bit more, form another pattern, then rise back up to recover that previous vector that it opened longs at when it started opening longs, when it broke price down. Yeah? Mad love to all of you guys. And if you're new to the channel, welcome to the hardest, easiest way to make money. Peace.